Despite economic indicators which show the recovery beginning to slow, the Federal Reserve this week raised interest rates for the first time in almost a decade, lifting the rate ever so slightly from rock bottom levels. The increase doesn't look like a lot, but it will have a direct effect on millions of us. To discuss what it means, we are back with America's Money Answers man, Jordan Goodman. Also, Jim McCarthy is sticking around. He's from Directional Wealth Management. And also joining us on this segment is Charles Steindel. He is a former executive from the Federal Reserve Bank of New York. Gentlemen, welcome. Let's discuss this. Good idea or bad idea?
Bad idea.
Why?
There's too much deflation in the world. Other places are lowering their interest rates. The European Central Bank recently went to minus 0.3, even deeper into negative, because they see the signs of deflation. As we talked about before, oil's down to 34. I think it could go into the 20s. And all the other commodities, copper, aluminum, coal, you name it, are plunging. That you don't raise rates when there's deflation in the economy. Supposedly the Fed looked in 1937 and they did the same thing, but they didn't take the lesson. So
now, Jim, your clients must like that they're raising rates because they're going to make a little more money.
Well, the clients that are living on a fixed income, certainly. And I tend to disagree a little bit with Jonathan in that I think they needed to do it, if not for anything else. Because they took some of the uncertainty out. There's been all this in the market, from my perspective. Right. The uncertainty is almost worse than the reality of the quarter point rate increase. Now, I mean, is it going to impact, home adjustable rate loans for car, autos, and homes? Yeah, it's going to have a little bit of an impact. But historically, our rates are still. I mean, Charles, you could certainly speak to this. Are incredibly low. I mean, so the monetary policy is still exceptionally accommodative. It may not be stimulative, but it's certainly accommodative. But Jonathan's points are valid. The European and internationally rates are going like this, and now our rates are starting to go this way. Right. But I think it's got more to do with they needed to finally get this out of the way. Get it out of the way. And then, I'm hoping that they will do a gradual, slow process, not sort of the Greenspan, a quarter point every meeting, which I think would be.
And let's talk about that in just a moment. But Jordan, Charles, the interest rate increase was sort of baked into the market. I think investors were waiting for it. They knew it was coming. Janet Yellen indicated weeks ago that it was probably going to happen. And then we had the market go up on the day that it happened and then go down 2 days. What do you make of that?
I can't make anything on a day. Moves in the market.
You were with the Federal Reserve Bank of New York.
Well, that's the point. We did stock market. We didn't try to figure out on a day-to-day basis. But first of all, I want to mention I'm also connected to Ramapo College, not the Fed. I want to get that across. Okay. The major thing is, if the Fed hadn't set all this expectation of rates and why they would raise rates, you need the economy at relatively close to full employment, which it is, and inflation is creeping up very slowly in the U.S. So there was a reason, and they had advertised that they would have lost a lot of credibility if they hadn't raised rates.
If you had a say in it, would you have done the same thing? Or voted for the same thing?
Probably not earlier in the year, but when it came to the point in December, when it came to time to make the move, then yes, I would have done it.
Now, do you see this? I've heard people say, well, maybe this is a one-off thing. They're going to wait another.
No, they're going to do more.
You think so?
I think they're going to do 3 more in 2016.
And why do you say that?
Because they want to get their rates up so that if the economy turns down, they've got some bullets to use. And so I think they're going to do it in the first part of the year, because the second part of the year gets very political and they want to stay out of the political season.
But we have people struggling out there really just to make the payments they can now, and they have these adjustable rate mortgages or loans and so on and so forth.
The prime rate
How do you sell that?
The prime rate went up from 3.25 to 3.5. So anything tied to the prime, auto loans, consumer loans, small business loans, mortgages to some extent, credit cards, all those are going to go up. So if you're going to pay more in interest, you're not going to get anything after for it.
Then it's already become political because we're in the political cycle right now. We're in the election cycle right now.
And I tend to think that they'll be a little bit. I think there may be an increase or 2 next year. The dot plot says 4. The market, basically, from what I do for a living, is saying 2. That's sort of what's baked into the numbers right now. So somewhere between 2 and 4 is 3.
In a
obviously.
deflationary environment, we're raising rates.
But I tend to think that they are going to be a lot more gradual. That they're not just going to do it just to have it. I mean, Jonathan's point about them liking.
It won't be every meeting. It'll be every other meeting.
It definitely will not be every meeting. I don't think, and it may not even be early in the year if the economy continues to stay soft going into the first part of the year. Now, if the economy seems to be strong, employment continues to be strong, and there is some indication of wage inflation, which is really, I think they're more concerned about that. There's a lot of deflation in the economy when it comes to the other things, but they're going to focus on wage inflation, I think, as a primary thing. So there may be increases in the first half, but I'm personally telling my clients that we're leaning towards the second half of the year to see that happen. Again, predicated on what happens with the economy.
Charles, not to become political, why didn't they just wait till next December? What would 1 year have mattered?
I think there's too much of the committee is worried that inflation gets into gear, that inflation goes to approach and goes above the 2% target. And I think that was the fear, that the horse starts to get out of the stable.
And how does that happen with gas prices falling, with food prices falling, with commodity prices falling?
If wages are growing, it'll happen.
Wages is part of it. I mean, the official inflation rate is now 1.2%. So we're not even close to the 2% official target.
I'm not disagreeing with you. I'm just giving you what the views are of many members of the committee.
But again, that's baked in.
That's the point.
Yeah, and that inflation rate is including the decline in the oil prices. Yes. So if you look at just wages, wage inflation is at 2% right now.
More deflation in oil prices.
Now, you mentioned oil prices, so let's talk about this now. They've gone down precipitously.
Correct.
And they continue to go down. And my question is, why are they going down?
It's a supply-demand situation. Demand is relatively stable, if not less, because cars are more efficient.
We're talking about India and China growing more, Chinese,
yeah, but even they're relatively efficient, but the real problem is on the supply side. So in the past, Saudi Arabia was the so-called swing producer. They produce about 11 million barrels a day. When they see the price going down, would normally cut back their production to kind of support the market. They're not doing this at this time. And now the new factors are all the fracking in the United States, and Iran, because of the embargo coming off, is going to add about 4 million barrels a day once they get fully up and running. So we have more supply. There are literally tankers waiting off the port of Houston filled with oil, no place to put it out. All the storage facilities are full.
What do you make of the move in Congress to allow the United States to
nice idea. This is not a time to export oil. There's no demand for it around the world. We got too much oil, but in the long run, it's a good idea that we can export oil.
Oil prices concern you, Charles?
I think oil prices, I agree, they might be a symptom of weakness of the world economy. China is slowing. I mean, China might be growing, but it's growing at maybe 7% if you believe their numbers, as opposed to 10 or 11%. And that's a big difference in the world economy. India is slowing, and Europe is basically a disaster.
Right.
So these are the three biggest chunks of the economy outside the U.S. U.S. is crawling up at around 2%. That doesn't add much to fundamental oil demand.
Does any of this play into the electric cars and more of these green cars out there? It doesn't really matter.
It hurts them, actually. I mean, it's been a big negative for the electric cars and for the solar industry. Obviously, those alternative energy solutions are more attractive with $100 a barrel oil than they are at $30 a barrel oil.
I mean, the change now is you've got this climate treaty, which looks like it's going to go ahead. So there's going to be mandates for electric cars and solar and all the alternative energies.
It's really a double-edged sword, because even though there are jobs being lost in the energy industry now by the thousands, we have more income, the average American does, because he or she is not paying $5
a little bit,
for
but it's not equal. The way I like to put it is, the pain of lower oil prices is concentrated, sharp, and quick. Okay,
Yes.
It's in places like Oklahoma, Louisiana, Texas, North Dakota, Wyoming, Alaska. They're really getting hurt very, very bad. The pleasure is diffuse and delayed. It's nice that your gas prices are down, but you say, oh, I saved $3 on my gas filling up, so let me go buy a McMansion and fill it up. Doesn't work that way.
Now, Charles, why doesn't the OPEC step in and try to control what they can?
I think there's just a lot
Turn
of
the
things.
spigot.
I think it's just a lot of things going on in OPEC. They have a lot of issues there too. They have growing populations as well. They have demands. They want to keep the money flowing in. And also, of course, I think they want to set back the fracking industry. You know, they think if we shut down the fracking industry in the U.S., it'll never come back, which I think is I don't think that'll happen, but at least they're trying it.
And I think the other part of it is, I mean, that's clearly part of it. And I just had a thought, and I lost it. Why don't they turn the spigot off?
Well, until you get it back, the concentration of oil and what it provides to not only the Middle East and the United States, as I mentioned, is this opportunity for discretionary money. But what you're saying is that people have gotten so used to spending all this money, especially in the Middle East, that they have to just to keep producing this oil to keep it going. But if there's no
look at Saudi Arabia.
I found my point.
Okay,
Sorry,
go ahead with your point.
Is that some of these countries, that is their only source of revenue.
Correct.
Russia, Saudi Arabia.
Venezuela,
Exactly. So in America, where we have lots of industry, we can afford to either produce or not produce, because we're still bringing income into the economy. But I don't know what the actual percentage is, but in Russia, it's a huge percentage of their GDP is the oil industry. Right. So if they don't produce, then they got nothing. So even if they're in a net neutral or a net negative, they've got to continue to produce.
And on top of that, all these countries are cheating. You know what OPEC stands for? The Organization of petroleum exporting cheaters. That's what they do.
All right, let's get back to what we're talking about, is the interest rates. How does it affect the average consumer? We'll start with you, Charles.
Well, obviously, as was said, interest rates go up, variable rate mortgage payments will go up. And I thought Chairwoman Yellen, Mr. Chance, when asked this the other day at the press conference, she detailed all that mechanism. She forgot to mention, of course, most likely passbook savings accounts rates will go up, and so will money market funds.
Minimally. They're not going to go up as much as the
basis
interest
points
rates.
or
I
so.
agree with you on that.
And there's been a lot of political pressure on the Fed for that. There was a rather notorious incident a few weeks ago where Ralph Nader sent her a letter openly and said she should ask her husband what to think about this, because
but this is what's happening though, because people are not going to earn as much on their savings accounts and passbook and so on, and they're going to be paying more. The banks' profit margins are going to be widening, and who is the constituency for the Fed? The banks. Okay, so the banks have been pushing for higher interest rates because they want their interest.
So what
going up.
you're telling me now, from what I'm hearing here, is the consumer is going to get it.
They're going to continue to earn almost nothing, and they're going to pay more. Correct.
So it benefits the banks and so on,
Correct.
and not so much Mr. and Mrs. John Q. Public who live somewhere in Des Moines.
And that's the constituency of the Fed, is the banks.
So knowing that, and of course the Fed members must have known this, why would they do that, knowing that people are still struggling out there?
It's not important to them. The Fed thinks they're in their own bubble. Okay, they want to have credibility, meaning by raising rates it shows they're being tough against potential inflation, which nobody can see out there right now.
But you being involved in the Fed, do you agree with that?
I think that's one view, but I think quite clearly the Fed is trying to look forward to where the economy will be a year or two now. They see a fair amount of strength in the economy. They see wages growing. They see incomes growing. They see a concern about inflation. I think they are very much aware the world economy is weak and has dragged down prices, which is why they delayed the rate increase from, say, June all the way to December, when you had this weakening weakening the economy.
Yeah.
They think of the world economic weakness as, to some extent, there's a little bit of panic here, and things like oil prices, and that'll go away. The dollar will weaken a little. The dollar should soften a little, and they would see a little more inflation show up.
If our interest rates go up and other currencies are going down, our dollar's going to get stronger.
It doesn't work that. If it worked that simply, believe me, a lot of things would
And Frank,
be easier in this world.
I'm in the camp that I think it was smart for them to do something, not only for their credibility, but also because, again, if they do lose track, which historically has been the Fed's problem of raising rates, then they have to really jam on the brakes. So I see this as like a little soft tap on the brakes to sort of ease the momentum, and hopefully that's what it is, and they can let the.
That's exactly what Janet Yellen said the other day. She was fearful of a situation where
really
inflation goes up, and we do have to hit on the brakes.
And that's going to upset the
What does it do to your investor clients? What do you tell them now?
I tell them it's a good thing, Frank. I think it's an underlying sign that they feel confident enough that the economy, the U.S. economy, can support at least a small nominal increase. Yes, they're going to see their interest rates go up on their car loans, and they're not going to see their passbook go up as an equal amount. The banks, the banks raised from 3.25 to 3.5 on the prime rate. I'm sure they didn't raise their passbook savings from 0 to a quarter. Right. They might have raised it from 0 to 1.1 or 0.15. So yes, in that sense, it's a net negative. But I think overall, the fact that the economy is good, it should have taken, the oil is a trade-off, should have taken some of the uncertainty out of the stock market, which again, if your 401k is going up, your retirement accounts are going up, you tend to feel a little bit better. Right, and I don't think it's going to hurt the housing industry too much.
We have 2 minutes. This is the last fresh outlook of 2015. Let's look ahead to 2016. Again, we have 2 minutes. Give me 30, 40 seconds. What do you think the economy is going in 2016?
I think the economy is going to continue. What we've seen is what you get. The economy is going to grow 2.5% a year. I don't think we'll add as many jobs as we did this year, which was a very rapid year, but we'll continue to see that. The unemployment rate will go below 4%. Inflation, I think, is probably going to stay close to current levels.
You think unemployment will go below 4%?
I mean, below 5%.
5%.
I'm sorry.
Into the fours.
All right. How about
5%.
I would agree. I think the employment situation is stabilized. I don't think we're going to see a lot of job growth.
You're really on the front lines of this, too, because people come in and they see you.
Oh, yeah. I mean, I'm talking to my 50-year-old clients. Those are the people that are either in their jobs and trying to make decisions about their future. Right. So, and I've also got 20-something-year-olds as kids, and some of my clients' kids are coming out of college and going into jobs.
So you think the job market will stabilize a little bit?
I think it'll be fairly stable. I don't think we're growing more than 2.5%. I think interest rates will probably on the 10-year stay somewhere in the mid-2s to maybe get up to close to 3%.
No, Jordan,
I think the economy is going to be weaker than that. I think
See,
it's going to be slower.
I thought you'd be contrary because we've talked about
I mean, all the signs of deflation we talked about mean the economy weakens, not only for the prices, but the people producing those commodities, the oil workers and so on. The two strongest parts of the U.S. economy this year have been housing and autos, both interest sensitive. So if interest rates go up, on the margin you cut back on the growth of the two big areas of the economy. The commodity sector is in deflation, so I think it could have a weaker economy, and the Fed raising rates even more is going to make it even weaker.
Well, I don't know if you heard about this, but Star Wars came out.
Yes,
and that's going to boost the economy.
That's the next segment. That's the next segment. When we come back, what it means to be a super fan, and explanation when Fresh Outlook continues.